I earned $95,000 last year and paid more tax than a man who made $200,000. Neither of us broke a single law. I want to be careful with this one because there is a version of it that is conspiracy nonsense, and I'm not making that. Nobody is hiding money in a vault. There is no secret. The rules are published. They are free, and anybody can read them. That is exactly the problem. It is not a secret. It is just that nobody ever sat you down and explained that there are two completely different rulebooks, and which one applies to you is decided before you were born. Here is the whole thing in one sentence, and then I will spend the rest of this video showing you it is true. The tax system does not care how much money you make. It cares what the money is called. $200,000 earned by going to work is called wages. $200,000 earned by owning something that went up and then selling it is called a long-term capital gain. Same amount, same year, same country. On the wages, you pay about $37,000 in income tax. On the capital gain, you pay about $23,000. $14,000 less on identical money. And then there's the second bill, which almost nobody includes when they argue about this. Payroll tax, Social Security, and Medicare on $200,000 of wages. That is another $13,800 out of your side alone. On the capital gain, payroll tax is zero. Zero. Not reduced, not deferred. It does not apply. Because payroll tax is a tax on working, and he was not working. So the real gap on $200,000 is about $28,000. $28,000 decided by nothing except which word appears at the top of the form. One word. Now, the obvious question, why would anybody design it like that? And the honest answer is not a conspiracy. It is a policy choice made deliberately, and the reasoning is public. The argument goes, money that gets invested builds factories and hires people, so we should tax it less than money that gets spent to encourage more of it. You can agree with that or not. I am genuinely not here to tell you which. But notice what it means in practice. It means the lower rate is available to anyone who has money that is already working, and it is not available to anyone whose money comes from working themselves. That is not a loophole. Nobody is cheating. It is the system doing exactly what it was designed to do, which is worse, in a way. A loophole can be closed. A design has to be argued with. And here's the part that took me a long time to get to, and it is the reason I'm not angry about it anymore. Being angry about the second rulebook does not move you into it. There's exactly one thing that does, and I ignored it for 11 years. You cannot turn your salary into a capital gain. That is not a thing. Anyone selling you, that is selling you something. But there is one door in the wall between the two rule books, and it is wide open, and it is boring, which is why nobody makes videos about it. Pre-tax contributions. That is the door. Your workplace retirement account. That is it. That is the door. And I want to explain what it actually does, because I thought I understood it, and I did not. I thought it was a savings account with rules. It is not. It is the one place where an ordinary earner gets to decide what a piece of his income is called. Here's what that is worth on $95,000 a year. Put nothing in, and your tax bill is about $12,500. Put in $7,000, and it drops by $1,500. Put in the full amount, $23,500, and it drops by $5,170. $5,170 this year for money you still own. You did not spend it, you moved it. And now the part that actually matters, which is not the refund. If you're in the 22% bracket, $500 leaving your pocket after tax buys you $641 of pre-tax contributions. Same money out of your account. Same lifestyle, 28% more arriving in the pot. Over 30 years at 8%, $500 a month becomes $745,000. $641 a month becomes $955,000. A gap of $210,000 for the same money leaving your account. $210,000 for filling in a form at work. For a form. That is the second rulebook. That is what it feels like from the inside. Money that has not been taxed yet grows on the untaxed amount for decades, and the difference is not small. And before anyone says it, yes, you pay tax when you take it out. You pay it decades later on withdrawals, usually at a lower rate than you are on now. And after 30 years of growth on money, the government let you keep working in the meantime. It is a delay, and the delay is the whole product. I did not contribute anything for 11 years, not a dollar. And I want to say why. Because I do not think my reason was unusual, and I do not think it was stupid. The form arrived in my first week in a folder with about 9 other forms. It had a percentage box on it, and I did not know what number to write. So I wrote 0, because 0 was the only number I was certain would not cause a problem. And that was the whole decision. 11 years decided in about 4 seconds, by a man who did not want to look stupid in front of a folder. There was also an employer match on that form. I want to tell you about the match because it is the part that still gets me. My employer would have put in 5% if I'd put in 5%. On $70,000, that is $3,500 a year. Free, not a good return, not a clever investment. Free money that was sitting on the table for 11 years while I walked past it every morning. $3,500 a year, invested for 30 years, is $434,000. I did not turn it down. That is what I want to be precise about. Nobody offered it to me, and I said no. I just never filled in the box. 11 years. And that is what the second rulebook actually looks like for ordinary people. It is not yachts and offshore accounts. It is a form in a folder in your first week. The rich are not using a different tax code. They are using the same one with somebody paid to read it for them. That is the actual advantage, not secrecy. Attention. Somebody read it for them. Somebody sat down and read the rules on their behalf, and nobody ever did that for me, and it is not because I could not afford it. It is because it never occurred to me that it was a thing you could do. So here's what I would do in order. And it is about 20 minutes of your life. First, find out if there is a match at your job, and what percentage triggers it. Contribute exactly that much today, before anything else in your financial life. There is no investment on earth that pays you 100% on the day you make it. That one does, and it is administrative, and most people leave it. Second, look at what your contributions are actually invested in. A pre-tax account is a container, not an investment. Mine sat in a cash fund for 2 years because nobody told me the container was empty. That is a different video, and I have made it. Third, and only after those two, worry about the rest of it. The truth is that most of the tax advice aimed at people like us is noise, because most of it is about the second rulebook and we do not live there. We have one door, it is unglamorous, it has a form attached to it, and it is worth $200,000 over a working life. Go and find out what number is in your box. Most people have never looked, and mine said 0 for 11 years. I put the boring arithmetic on this channel with the 11 years I lost left in. Subscribe, if that is the version you want.